GMGM everyone, welcome back to another episode of Touchgrass Podcast. Today we're continuing with the VC series. We have Richard from Varrock, who's also been part of one confirmation before. We're going to talk about raising new fund in a bear market, current themes, what's going on, and also you know kind of correlate with some other themes that are happening in the AI space as well. But yeah, welcome to the show, Richard. How are you?
Good, good. Glad to be here.
Awesome. Why don't you give a quick intro about yourself and also talk about first your time at One Confirmation, how that was, and then your transition to starting your own thing.
Yeah, for sure. So I've been a VC in crypto for almost a decade now. I started my career with One Confirmation. I was there since the start. So from 2017 to 2024 as GP there. Um, Went through many different crypto cycles. So I remember the ICO boom, and then DeFi summer 2020, and then NFTs 2021. It was a big part um, at like several big portfolio companies like OpenSea, Polymarket, Bridge, Nexus Mutual, DYDX, and others. And then 2024 summer left One Confirmation to start this new fund, Varrock. And it's just myself as a solo GP, investing pre-seed and seed, 900K tickets, pretty generalist. Anything that touches crypto is fair game.
Awesome. Like you have written, I love your writing, by the way, and you've written a lot on recent topics. You've written about founders and whatnot. If you had to say there's one thing right now, obviously you're investing into not just a singular bet kind of theme, be it props or prediction market, something like that. You're kind of more broader. What's one contrarian bet would you say you have right now that people are not really looking at, but is kind of
One
obvious to
contrarian
you?
bet. Um, I would say non-USD stablecoins is a contrarian bet. I think most people have written off non-USD stablecoins because if you look at dollar stablecoin market share, it's like 99.3%. So like non-USD is just like a tiny rounding error. I think why dollar dominance has been so big in stablecoins is like historically, like the biggest use case of stablecoins is crypto to crypto trading. So if you're trading on centralized exchanges like Binance, like Tether is the reserve currency. Like Bitcoin is denominated in dollars, ETH is denominated in dollars. If you're a trader based in Europe, you think about Bitcoin price in dollar terms, not euro terms. I think that's changing now quickly because stablecoins are being used for more real world use cases. So things like payments, remittances, asset management. And as you get more real world use cases, like often due to accounting, companies have to settle things in whatever their local currency is. And like it can't work if everything has to be dollar denominated. And actually, if you look at the data, in 2025, I think USD markets cap grew by like 60%, and then non-USD market cap grew by like 3 to 4x. Um, so just like a small TAM expansions from like say 0.7% market share just to like 5% or 10% is like already a massive TAM expansion. And then if you look at TradFi, like FX markets, dollar dominance is about 50 to 60%. And I think eventually crypto and TradFi are going to converge. Um, so like to highlight some portfolio companies, two I recently invested in are Agant, which is a British pound stablecoin issuer, and Pimlico, which is a Euro stablecoin issuer. So I'm really excited about non-USD stables.
Have both of these teams like shared any unique insight on why there's USD dominance? Like, is there something that they're going to do differently? Is this more of a compliance thing than anything else?
Yeah, I think one unique insight is like a lot of stablecoins has to do with geopolitics and regulation. So for each non-USD team, like it has to be a local team. Like for Agant, for example, is like they have to be buddies with people in the House of Lords and acquire the FCA license, which they did back in February, to be able to operate. Um, and also, like talking to the Agant founder, one unique insight he shared was actually personal. At his previous firm, he was trading commodities, agriculture commodities. So he was trading carrots. and like they were looking at using stablecoins for a lot of cross-border payments. But the problem at the time is like all stablecoins are dollar denominated. They have to do their accounting and settlement in GBP, and that kind of sparked him the idea to leave and start a GBP stablecoin issuer. So yeah, a lot of local insights if you talk to people in the region.
And I think another way to kind of describe this whole idea is basically we have kind of not top, but kind of hitting that peak when it comes to US kind of globalization, and everyone wants to kind of de-risk a little of that and go into emerging markets a bit. Is that kind of also a reason to kind of bet on these emerging economies and more of the denomination will be in other stablecoins?
I think a lot of emerging markets will still be dollar denominated, but you do need local currencies for like the FX rails. Um, so, right now, how companies like OpenFX, even TradFi companies like TransferWise, how they work is they front liquidity on all these different currency pairs, and then rely on market makers to do the last mile swap. And like market makers are charging like tens to hundreds bips in fees. I think as the market becomes more efficient, once it gets to like sub 10 bips, then eventually you're just going to have local stable coins, and you can do like swaps at mid-market price on Uniswap on like decentralized exchanges, and like that'll get you the best price. So as market matures, I think FX will come on chain. And also speaking of that, like FX is the largest market in TradFi. It's like probably like half of TradFi volume is FX and swaps. And the crazy thing is there's no central exchange in TradFi for doing FX trades. It's all peer-to-peer, where some OTC desk at Bank of America will call the OTC desk at Barclays and then negotiate on the pound dollar exchange rate. And like the reason there isn't a central exchange for FX is because you need this like global government, and you need this trustless third party, and like that's perfectly what the blockchain is. So I imagine a world maybe like 10 years from now where all stablecoin, all FX trades are done on chain with stablecoins at the best rates.
Yeah. Rachid, if you remember, we had the mentor team, I think last year, who was like the FX layer on chain, and they were saying that besides the US, I think Europe and other, I think they mentioned a few other emerging, maybe Nigeria as well, where they have like the most liquidity on chain for these
Yeah.
swaps. So that's definitely growing, and that was last year. So it must have even grown further this year. But Richard, I've been talking about, like there's been like this hot topic in VC in crypto that there's not much capital. Everyone is, not investing that much, and people have gone to, finally pivoted, not in 2023 but in 2026 to AI. What's your take on this lack of capital debate that people are saying? Is there really not that much dry powder to deploy in these markets, or is there a lack of just founders or the projects, interesting projects to kind of back?
Yeah, I had like kind of a controversial tweet a few weeks ago. I argue like there's still an oversupply of capital relative to the number of quality projects in the space. It's just people are mostly sitting on the sidelines, not super eager to deploy, and like the bar for getting funded has gone higher. I think a lot of it is just due to the fact that a lot of money in crypto in the last few years has gone towards like token projects, just kind of like useless like infrastructure like vaporware projects, just to try to do like a token flip, and like that game is pretty much gone now. You might get say like a 1 to 3x return, but that's not going to be a fun returning outcome. So like with that said, it's like what are the investable areas in crypto that have venture scale outcomes? And it can either be like on-chain revenue generating businesses. So a lot of it be like trading businesses like perps with hyperliquid, prediction markets like Polymarket, or it can be like Web 2.5 like businesses, stablecoins, payments, asset management, and there's just like fewer good opportunities if like those are the areas that you're targeting. So yeah, I think there's still enough capital in crypto. Just the number of quality opportunities is less if you take out like all of these token projects.
No, and that makes a lot of sense. And I think that sort of segues into sort of evaluation frameworks really well. I think one of the biggest changes, as you mentioned, in the past sort of 6 months or 1 year is a lot of these Web 2.5 type projects have come out, projects that are trying to optimize traditional businesses with stablecoin rails or blockchain rails, type of projects that a traditional sort of crypto native VC might not want to look at. And when you have an oversupply of these sort of businesses, and when you look back at DeFi Summer, the type of projects that were coming out then are probably not that innovative now. As in comparison, how does the VC evaluation framework change for a Web 2.5 business that's integrating crypto rails versus what we saw during DeFi Summer or during that similar cycle?
Yeah, so like with DeFi Summer, like I'm assuming like these are like all token projects. Is like, does
Yeah.
this token have the right narrative? Is like, is this a good meme that can be like a several billion-dollar market cap coin? Because the reality is like most of these tokens trade at absurd multiples on fundamentals like revenue. So valuing off of those multiples is like not the right way to look at it. It's like, is this a good token network? Is it like Bitcoin, which is a really good which is the best meme in crypto? Can it be like some fraction of that? When you're looking at like Web 2.5 businesses, you're really crypto is just probably like 10-20% of the business. So you're really evaluating it as like a traditional business. It's like, can they generate revenue? Like, how big is the TAM? Can this be a 300 million ARR business? What's their go-to-market? How competitive are they in this market? Are they going to be the category winner, or are they going to be like a tier 3 project that's losing to much bigger incumbents? This is kind of like, these are like all the rigorous questions that like a traditional VC would ask, not a crypto VC. So like it's a different mindset that crypto VCs historically now have to become more like Web2 VCs.
Yeah, and also where do you like? I think this relates to the same topic, but where do you stand on the equity versus token debate? Even though it might seem controversial, but I still love tokens. I just think they are done. They have been done in the wrong way over the past years, and the market has come to realize that. But where do you stand on the whole equity versus token debate? I personally think most projects should just, as soon as possible, launch their token. But where do you stand on that whole thing?
Yeah, I mean, to be clear, I'm still bullish tokens. There's just very few token models that work. So I think the two that work are kind of token network store of value monetary premium, and the other is like a revenue backed token. So like the store of value monetary premium, that like the best example would be an L1, like Ethereum, Solana, is like you're kind of comping to Bitcoin, and like trying to see is like if Bitcoin is X% market share and I'm like some fraction of that, that should be the value of the network. And you can evaluate network value from like usage, like transaction volume, TVL, things like that. And then if you're like an application layer project, like a trading project like Hyperliquid, then you're evaluated based off of flows, which is downstream from revenue. And like Hyperliquid, I think is about $1 billion revenue run rate annually. And like you can value tokens based off revenue multiples, kind of like what you would do with equity businesses. It's just that there's a lot of tokens out there that are just kind of meme coins that it's like this pseudo governance token that was kind of forced due to bad regulation, the Gary Gensler era over the last 4 or 5 years, where like they couldn't attach revenue to the token because it might be a security. So they have to do this like convoluted meme coin governance structure, and then that just questions the utility of the token when you're not a token network like an L1 or a Bitcoin.
Yeah.
And equity businesses, I think, are just easy to value. It's just based off revenue multiples and TAM and comps.
Yeah. And Richard, I remember vividly reading a tweet from you last year. I think it sort of positioned, like it said, ETH needs a new narrative to win. Talking about sort of Bitcoin in correlation with ETH and Solana and how to value networks. with all the institutional push and all, we're scaling the L1. Do you think ETH has found that narrative in 2026? Where are you on that entire sort of narrative?
Yeah, I mean, so I wrote that before, Vitalik wrote the article of like L2s were a mistake, and then now we need to go back to scaling the L1, which is what I think should be the correct playbook for Ethereum. Um, I think Ethereum is, because the Lindy effect, it's been around the longest. It has like the biggest trust and brand for asset issuance on chain. That said, like I feel like the Ethereum Foundation is still a little too researchy, like pie in the sky. Like if you read the latest report the EF wrote, like you do like a command F search, it's like you see like privacy mentioned like 30 times, and like stablecoin is like not even mentioned in the report. So it's still very much like an R&D org and not really focused on go to market. I think that's kind of where Ethereum's lacking. I say in general, like ETH and Solana, I'm becoming more of the view that ETH and Sol trade kind of range bound, like commodities, and then Bitcoin's like the asset that keeps going up and to the right. I think it's mainly because if you look at like net new inflows coming into crypto, like now it's almost all institutional inflows, not retail, and like institutional flows are going into Bitcoin, like with the ETF. And because it's not retail driven, once it goes into Bitcoin, it doesn't trickle down to the rest of the alts, which is different than retail. Like back in 2021, when people go risk on and then gamble into NFTs, meme coins, and other assets to get higher returns. So I think you can see a world where Bitcoin continues to set all-time highs, and then like in 2025, ETH and Solana like barely reached their previous all-time highs, and then just traded back down range bound.
That makes sense. Do you?
Yeah.
So is the fund only like venture? Considering sort of how deep your analysis is, do you also do liquid?
I do some liquids, but just the majors like Bitcoin, ETH, and Sol, and it's mostly Bitcoin.
Got it. Got it. Yeah, I think even I'm on your side where when I read that piece that ETH needs a new narrative, the whole ultrasound money thing, I think that was too old. Even the scaling part right now, what that's happening, even though it's the right direction, I think people have not catch on to it yet. And this whole productive money kind of narrative that all the ETH arms are doing, even I don't think that's quite working for them. Uh, and even then, so on the Solana side, the activity has to pick up so much that that makes it attractive again. But yeah, I mean, even Bitcoin, I think it's just too dependent on one person right now. Even
So you
though
mean ETH
you
is
have to,
depending in person or Bitcoin?
I mean, like Bitcoin. So I think like even like you mentioned that even these things are range bound. I see a scenario where if Saylor kind of stops buying, he poses kind of certain risks, even though he can't get squeezed out and the dividends and all of that, there's years out, but he still, I feel like, caps Bitcoin in a certain way for institutions. Where do you like kind of stand on that? Where one guy, even though he's doing some magic right now, but what do you think about that kind of scenario?
Yeah, on DATs. Yeah, I used to be worried that like DATs have the risk of unwinding. Like when they're trading below NAV, activist investors will come in and like force sale of the book, which is Bitcoin, ETH, whatever the DAT is. I'm As time goes on, I'm more of the view that they're just kind of permanent capital vehicles. So it's like it's a liquidity sink for Bitcoin or whatever, and
Yeah.
there's less and less risk of DATs unwinding, especially like the longer the DAT's been around.
Yeah, I think on the ETH side, we've had on the Sharpling guys and a few others as well. The staking angle is interesting, and maybe they'll do a preferred thing as well. But them earning, I don't know, $1 million a week in case of Sharpling is pretty interesting. But Richard, I think we want to talk about, your tweets and thoughts about founders in general. It's super interesting. First, like, who are some of your favorite founders in the space? and what is one or two traits about them that makes them special, and others can kind of, who are just starting building, can kind of follow and kind of learn from.
Yeah, I did a tweet a few months ago about like kind of the different eras of crypto and like the right founder archetype. And just to summarize that, I think pre 2020 was a lot of the missionary founders. So people who came into crypto for decentralization, libertarianism, privacy, like these ideals. And the reason those founders succeeded was because there's just like crypto was so cyclical and you had to be able to survive the bear markets. So if you were ideological and missionary enough, you basically survived until the 2021 ZERP era and like you did well financially. Like all you had to do was like not quit and like pivot and like leave to another industry before 2021. And I say like from 2020 to 2025, that's when you had on-chain summer. So you had all these DeFi projects like NFTs, perps, trading, prediction markets, and like the founders that succeeded were the ones who like really understood like the trenches, kind of crypto native degens, tokens, what products people like to speculate with, understood like meme culture, how to build a community and following on Twitter. Those were the founders that did really well. And then I'd say like mid last year, that's when I started to notice another paradigm shift where like now, like a lot of the best founders like aren't on crypto Twitter. Like the most recent investment I did, both the company handle and the founder both aren't on Twitter. And it's like a lot of operators who come from fintech, TradFi, because if the next wave of crypto is like Web 2.5 and you're selling to institutions, you kind of have to have that background or like be able to speak that language to build trust. It's not like you're immature crypto Twitter degen who's like building for a crypto audience. So I think like looking forward, the wave of successful founders is going to look very different. It's going to be more like fintech, TradFi, like not people who are terminally online on Twitter.
Would you say the crypto native founder archetype is dead now?
I wouldn't say dead. I think you just have to reinvent yourself and learn new skills. And like, that's always a challenge. Like, I guess like Shane from Polymarket is a really good example where, he's this like young kid who like rose to prominence just from like memeing very well on crypto Twitter and like really understood Gen Z financial culture very well. But, like now you're talking to the CEO of New York Stock Exchange and all these TradFi institutions. It's like you have to be more grown up and be able to speak their language. And like that's just a new skill you have to learn. So like I think the smart founders are able to reinvent themselves and learn new skills. Others are just kind of stubborn and kind of locked into their old ways.
And you would say this is a
Yeah.
skill that even someone building an innovative DeFi product should learn? Like, would you say even if they don't expect institutional flows to come in for another few years, like is this something that you evaluate on all the founders that you talk to?
Well, I think founder market fit's really important. So it depends what product you're building. If you think your users are going to be like on-chain whales, like kind of the trenches, then yes, like talking to institutions is like less important. I think where DeFi is headed is like all of the blue chip projects like Morpho, Aave, others. They're all like talking to Apollo, BlackRock, these institutions because that's where they think they're going to get the next few billions of TVL. I think that's why there's been like that shift in DeFi.
Awesome. So we covered people. I want to talk about places next. I saw this, I think, from Bill Gurley, who's talking about places can be really powerful and they increase odds of success. And so one of the is like in the AI world that we're seeing often is everyone building in Silicon Valley. Is there something like that right now happening for crypto where founders going to that particular place just increases the odds of success in terms of network and whatnot? And most people say it's New York, but where do you think that is right now for crypto?
Yeah, I think crypto is unique from other industries in that the whole industry is pretty decentralized. Like I saw a stat like for AI is like over 90% of AI unicorns are based in SF, which it's pretty crazy. So like clearly if you're building AI, your odds of success increase if you go to SF. I think crypto, yeah, if you look at historically at the companies that have all succeeded, they've kind of come from like random places and like founders who don't have the correct pedigrees, like Stanford, OpenAI, where like most VCs would look for. And I think that's just like the nature of the industry being like global and terminally online, where conferences are held in different cities around the world. So like looking at my fund's deal flow, New York is still the dominant place where founders are based. I'd say probably like a third to 40% of founders are based in New York. After New York then it's London, then it's mainland Europe, and then it's SF, and then it's kind of rounding error after that. So there
Well, the Dubai founder arc is dead now. Like you don't get a lot of deal from
are.
Dubai.
I think Dubai is a lot of traders. So not really like entrepreneur founders, more of like trading firms, hedge funds, or people who've like gotten really rich and are like kind of semi-retired for tax purposes. Um, but I actually haven't seen that many new founders out of Dubai.
Got it.
Well, that's insane. Cool. Like Richard, like me and KG both live in India, so we actually see a lot of founders move to Dubai. So that this is like completely new.
Okay,
Uh,
yeah, I'm US centric, right? So
yeah,
like
yeah,
I
yeah,
have my
of course.
bias. Yeah.
And then Richard, let's talk a little bit more about the fundraiser. I know we're getting closer to time, but there are a lot of questions we do have uh, about the sort of shift of running your own fund. How, we've been seeing this narrative on crypto Twitter about, funds not being able to raise. How was that experience for you back in 2024, where I would say the market was a little bit more conservative? We were getting off sort of this horrible bear market because of the FTX fiasco. How was that experience? I would assume if you announced the fund in 2024, you'd been raising in 2023, which was even worse. Uh, how is that?
It was a 4 month fundraise actually. So it was like late 2024 when I put the fund together. But yeah, fundraise was like very hard in 2024. Just like the overall sentiment is like most LPs over deployed in 2021, 2022. They're out of liquidity now, and they're just waiting for liquidity before they can make more fund investments. And on top of that, you have this like AI backdrop where AI is like sucking all the liquidity and attention. So like LPs want to reallocate more capital to AI. So they're actually like trimming down their crypto exposure and reallocating more to AI. So there's just like very few LPs that have money. And I think I was fortunate enough to be able to raise from institutions. So like institutional capital is more sticky and they can work with you long term. But if you raised a fund in 21 from like a bunch of like individuals, so like say sub-$1 million checks, you say you have like 100 plus LPs, you're in like a much more difficult spot when you have to now raise in a bear market because most of that capital is not coming back.
Would you say a lot of the major funds in crypto are sort of suffering from that based on your conversations with different
Yeah,
funds?
without naming names, pretty much like every fund has downsized. Um, I can say like the ones that have gone up, like Dragonfly went up to 650. Um, Framework was able to hold at 400. Um, but I think most funds have downsized.
And then, Richard, as a capital allocator, does this narrative of AI sucking up liquidity also put thoughts in your mind about allocating to AI as well? Is that a conversation or a thought that you've had before?
Yeah, a lot of VCs I talk to like have talked about like expanding the mandate into like more AI investments. Um, I just worry that like if you do that, like are you just chasing the narrative? Like, do you have a strong edge? Like, are you able to compete against like Nat Freeman, Dan Gross, people who have access to the best AI talent, or are you just getting adversely selected? Um,
Yeah.
and I remember like back in 21 and 22 when like crypto VCs made fun of all these trad VCs that like aped into crypto, like FOMO'd and like literally top ticked everything. And then like I worry it's like now it's going to be the other way around, where like crypto VCs are FOMOing into AI, like pre-Anthropic IPO, and then like you might top tick it. Who knows?
That makes sense. Richard, we are getting close to time. We do have a couple more questions, this last two.
Yeah, I have
One,
this.
okay, good.
The one thing that, yeah, the one thing I'm super interested and was keen to ask you about for a lot of VCs is, we see this in like AI fundraising and stuff where, if I'm backing OpenAI, maybe not every VC is also going to invest into Anthropic. So they don't do this hedging of sorts by investing into all kinds of models. They just pick one thing and just go all in kind of thing. But in crypto, we kind of see people, and if there's an L1, they invest into like a dozen L1s. Is that like common thing in crypto with where VCs hedge a lot, where they back multiple indexes, they back multiple L1s, they back multiple prediction markets kind of thing? Is that like still a trend, or do you see like people just having more conviction into one winner?
Yeah, so like investing in competitors. I'm always of the, well, I've been of the mindset like that, like investing in competitors is like kind of a sign of weakness, that like you don't really have conviction. And like there are issues with investing in competitors. One is like the conflict of interest risk, right? Especially for like my stage where I'm like the lead investor in early stage. And like you can't have like information rights in like two companies that are going after the same market, like talking to the same customers. And the other thing is like the power law is that um, there's only going to be one or two company per category that are going to capture almost all of the returns from that category. So like the more you hedge your bets and kind of spray and pray into like 10 different perp dexes, the more likely you're just going to capture the long tail. So like the perp dexes that get like 0.1% market share, which like no one cares about. So it's important to like have conviction and just kind of double down in the market leaders.
That makes sense. Richard, are there any sort of fund winners that you'd like to highlight, like portcos that are clearly winning right now?
Well, it's only been like a year and a half into the fund, so it's still very early to say. Um,
It
yeah,
takes 10 years for the track record to kind of be visible, right?
yeah, I mean, yeah, it's still, yeah, it's still early to say.
Awesome. And then, Richard, last question from our end. Are there any missed deals or deals that you saw but didn't invest into, but that have done really, really well that sort of keep
Oh,
you up?
so many. I mean, like, yeah, the longer you've been in the VC business, like yeah, your anti-portfolio will always be worse than your portfolio. That's just a fact. But like I come to realize that's a sign that you have good deal flow, that you're kind of seeing all the best companies. I mean, the biggest one like financially is like obviously Solana's seed. This was back when it was called Loom Network. This is like early 2018. It was at 30 million FTV, not like $30 per soul. So yeah, you can do the math on what the return on that is.
Awesome. Richard, any final advice to any founders that might be reaching out to you to pitch? What are you particularly looking for, and sort of give any motivation for them to sort of survive through this market?
Yeah, I care about like how deeply you've like thought about the industry, the category they're building in, like, and like you're not kind of chasing what's working right now, what the hot trend is. That you have like you build conviction from first principles. Yeah, and like those conversations are always the most enjoyable to have.
Awesome. And also, Richard is super active on Twitter and he's very approachable as well. So do reach out to him if needed. But yeah, this is awesome, Richard. Thank you so much for your time. Talk soon.
Cool. Thanks, guys.
Thank you.